I'll be covering for Brannigan for a few weeks, and I'm going to be looking at some more market profile and specifically footprint strategies and trades, which which is used here in the office, is used by myself, and or the development of strategies that use the footprint. And today will actually be a video of a very recent strategy I've developed using the footprint to address a very a common problem I've been having in trading a certain type of days in thicker markets like treasuries or even bunds and so on, but mainly treasuries and so on. So if you get started, so essentially, if you've been looking at or trading treasuries for the past month, December and November and so on, especially, there are quite a few days, or quite a few too many days, where you have this persistent, as I call them, this very grindy trend day. If you would analyze the chart or look at the chart the day after, you'd see, oh, look, that's a beautiful trend day. It's very persistent bid or offer throughout the day. But if you're actually sitting there trading it, it was actually quite hard to trade it because it's very grindy. And what I mean by grindy is this persistent inability for the market to come off the high or low. So in this video, I'll be going through, explaining more what these kind of days are and the dilemma I had in trading them in US Treasuries and German bonds. We'll be looking at the context and the cause of these days and how I use the footprint to provide a way to access these kind of trades. And I thought, since this is my first video as well, I might give a quick explanation on how I've developed in using the footprint from something which I didn't really understand and I didn't really use to something I now lean on quite heavily during the trading day. Now, so how do we define a grindy trend day? So as I briefly mentioned before, it's a kind of day or a day type, using market profile terminology of trend or trend-like, but the market never really comes off the high or low. It's very sticky. The pullbacks are very shallow, and it doesn't make, it doesn't make these obvious, nice, pullbacks where you could easily join with the trend. It's very It creates this sort of feeling like anytime you're going to pay the high, the second you get in, the market, will squeeze you exactly how many ticks it needs, so you can just, end up stopping out or getting out. And but if you don't join in, and if you don't join in blindly and click the ladder and just get in, the market is just going to go another 30 ticks, 20 ticks, depending what market you're talking about, throughout the whole day, and you'll just sit there for 2 hours watching it doing so. And there's a lot of these days in December, a lot of them in November, and I was thinking, there must be some kind of way to actually trade these kind of days, because, I was just sitting there aimless, flailing around and not doing much, or ending up taking bad losing trades somehow. So the way we could define this sort of grind and trendy day, importantly, is that it has a very obvious characteristic of large players or players or other time frame activity, again borrowing from market profile, in the sense that you feel like someone's there, someone wants to get business done. They're constantly anytime you see volume coming in, and as I put on the slide, even any tiny pullback, any kind of, let's say the market's moving up higher and we're constantly bidding throughout the whole day, any sort of counter offer that does come in, it's quickly just instantly snapped up, and the market goes right back to the highs, and then progressively takes out the next high and slowly churns and just keeps taking out the next price, and never really comes off. And I think the most important part with these kind of days is that you need to be off the back of some kind of strong change in sentiment, or you want to have very heavy correlation with other markets coming in. So let's say if you have a grindy trend day in bonds, you want to have gold again on the highs throughout the day. You want equity to sell off You want those correlations to come in for to give another reason for bonds to move in one way. Or you'd prefer also to feel like there's a decent amount of positioning that has to be unwound. Let's say the market is very short, and you can assess that through various means, profile, or on the charts, or just sort of thinking about the meta game. And you feel like there's size that has to come out of the market now because it's gone the other way and everyone needs to get out. So I think that's very characteristic of these kind of days. And that people that need to get out, or there's a change in sentiment, to give a reason for people to get in the market, they're not really going to care about letting the market come back, letting treasuries, letting the US 10-year come back a tick or 2 ticks. They're just gonna just execute and just hit the price, and the market will just keep going. And yeah, as I mentioned earlier, it's very hard to access at first sight. Personally, you could argue, why overcomplicate it? Why not just get in, pay the high, and then close your eyes and give yourself a certain random stop loss in the middle of nowhere? And if it works, it works, and if it doesn't, if you do it enough times, maybe that has some kind of positive expectancy. But I'm not a fan of that, and I know that I'll just sit there, in pain, at just some random entry. So, this is the dilemma, this is the context of where you would find these kind of days. And here I've put in actually a very recent example on the 13th of December on the US 10-year. Now, what happened was on the 12th, so the day before, on the 12th of December, is when we had that big day where Trump came out with a tweet. I can't remember the exact wording, but it's basically a very positive spin on a phase one deal being done with China, and is basically done, and everything went risk on, equity bid higher, bonds sold off. You can see on here, if you watch my mouse, essentially on that day we just turned into a very persistent trend day, and it was very nice to trade news on. But the day in question we're going to look at is actually the 13th, so the following day. So the following day, the market really didn't do much at the beginning. It was waiting for a meeting that was, if I remember, streamed live from China with the ministers convening and essentially confirming what was essentially guaranteed the day before on US media outlets, that the deal's being signed is done, and they essentially agree, at least in principle, but it still hasn't been signed as of today, officially. But the interesting thing was, you could tell from the heavy volume on the 12th, you could tell from the way the market traded very aggressively. There's a lot of short positioning that day, and on the 13th, we were basically confirmed what we knew on the 12th, and essentially the market is already priced in what we already know. So there wasn't much reason for treasuries to sell off again and do another leg lower. And then basically, if you look at the chart from, essentially this small range here, after the meeting, the market just released, and throughout a period of a few hours, it just constantly turned into that, exactly what I described in the previous slide, a very grindy trend-like day where it was just, or trend-ish day where I was just constantly taking out the high with very, there are a few shallow pullbacks here, but even then, nothing to very much, get you in. And, you can see what kind of day this turned into on the 13th. Again, very kind of trend-like. And the problem with these situations is that there's no real reference point for you to trade off. No real levels, no real, market profile levels, or, the way you could orientate yourself around. And, I sat by the sidelines in that period because, I was, again, had no real way to access this. So following from that, I did a lot of homework, and, I came up with a way to access this kind of, these kind of days, and I actually used it, okay-ish already in January. Well, when I mean okay-ish, it went pretty well in January in terms of adapting this kind of strategy. So the pattern or the strategy, or in question, is as such. So what you want to look at mainly in this footprint, and I'm a fan of using a range chart. For some, I've also used time-based footprints. But I think the most applicable in this case is a range chart, and I use that on a six-tick range on US 10-year, on this kind of footprint. And the two main things I look for in this is something that keeps cropping up again and again, and essentially everything revolves around the concept of unfinished and finished auctions. And I'll just quickly go through this again in case we're not so sure on what that means. So essentially, the way these unfinished and finished auctions occur on the interaction on the ladder, or at least in order flow, is that, for example, if you follow my mouse here, when the market traded into this price here, essentially those 380 lots hit the bid, but the offer never moved step down for anyone to lift the offer on that same price. And what happened is we hit the bid and we quickly got snapped back up and then traded higher, essentially. So that's a finished auction. And the counterpart to that is an unfinished auction, which is essentially these price levels where you can see those volume traded both into the bid and the offer when that bid was there, and then when that offer was there, and so on. When you read about them, when you learn about them, there's that concept that unfinished auctions are like essentially unfinished business, or business that needs to just be traded through. And there's that claim that, which I think is true, that small tendency for the market to come back to these areas and trade through them, at least a tick or more, or at least try and test through them again. And that concept of coming back to trade through them and why that happens, I'll explain a bit later in the stream. But essentially, what this happens is it just shows a tendency or a willingness for the buyer in this context, at this price, for the buyers to not only take out that price but also to step up and add and add and stack that price with bids, essentially. And again, I'll explain why this is useful in this context. But essentially, you're looking for, as the market churns, it leaves these very sort of ledge-like, thick-like volume at certain prices. And again, this is why I think this pattern is much more relevant on thicker markets like treasuries, is that, you move higher and we churn, move higher, churn. And then what happens is we come back to that price, and very quickly we put in this low, consistently lower volume. And what happens is when we trade this unfinished auction, if you watch the ladder, it'd be a very quick and sharp snap. So it doesn't sit there for very long. It just trades through it, trades the 380 lot in this case, or 98 lot in this case, or again 385. It literally just tags it, and then bang, quickly goes up again. Very quickly, you get a very sharp reaction. And that's what I meant earlier. You have, because the buyers are just so persistent, they just snap up any little counter offer that comes in. They snap it up and, it just goes higher. And then the market progressively just takes out these unfinished auctions, all on the way up. And I know this, you might be thinking, wow, this looks pretty easy. Why not just, of course, this example is, it's actually, on that day. But I did choose it because it was the clearest. It's never going to be, 100% clean like this every time, but it's the clearest, example to illustrate the point. So essentially, what the three main things you're looking for is this ledge-like structure to be broken very conclusively, and the market to put in a very aggressive low with a finished auction, and then you want the market to trade back up and persistently just take out these unfinished auctions, at the highs, and as long as the market backs off and leaves an unfinished auction and quickly trades back up, that there's a decent, the tendency for the market to come back up, so that in itself essentially gives you a trade. And there's a little positive edge there where you can, essentially just scale yourself into that trade, or get in, or manage it how you like. But essentially that's the pattern. And it doesn't require the market to back off that much. Now, one thing I'll address is why 6 ticks, why not 5, why not 7 or 4? And I think, if it's slightly different, or however different it is on the markets, it's not as important for it to be 6 or 5 or 4. I think the main thing why I chose 6, and why other people might choose slightly more or less, is that again, through experience of just trading this market, I prefer 6 ticks. But a quick and easy way to figure out what's best for you is, if you look at the ladder, essentially you watch it throughout a period of an hour or two, and you want to see what your brain notices in terms of when the market's moving in a certain direction. How many, what's the range in terms of it? What's the rotation in it backing off? How many ticks does it back off before it continues the same move? And how consistent is that rotation? And if you notice most of the time in your market, it can be 6 ticks, 7 ticks, 8 ticks, then you should use that as a, your footprint. I would argue your footprint range charts, essentially. So now, so essentially what we should address is why is the footprint actually relevant and useful in this context? And the thing to note is I didn't approach the dilemma of trading these kind of days thinking, okay, I'm going to use the footprint, let's find a way to somehow use it. I have various tools at my disposal, just reading the ladder, looking at footprint, using other things. But the thing that provided was the easiest, the most clear cut was in fact the footprint. And now if we assess why the footprint is actually relevant and useful, it's because when you're in these kind of churn days, churn type action, and there's no real levels or no other points of reference or significant areas, is that it provides a sort of information for your brain that's easy to categorize. Because you have so much information coming at you from the ladder and from other places. It's a way to sequence that order flow action for you to very quickly see it and assess, above perhaps other tools you can use. And again, as it says here, because of that, it gives you something to lean on. It gives you a defined area where you want to, enter and exit, because that's the expectation of something, happening or not happening. And by that I mean, that if you're in the correct kind of day, the probability of these kind of lows, these very snappy like lows with finished auctions holding and continuing, are actually quite high enough where I think most people will be willing, to put on a trade because of that, at the very least. And then of course you can exit because if that area keeps getting, if the market comes back to this level, churns it, and then slowly comes back down, that probabilities of that move continuing, or at least continuing, consistently, is probably less, or it's the move's done and you might as well exit the trade because your reason of being there is now gone. And if you think about it slightly differently, this pattern in of itself, if you take in pure isolation in a vacuum, that has a slight edge in of itself, in that a minuscule, I wouldn't say enough for you to trade that in a, out of context, which I wouldn't advise, but that the market does have that small little tendency that these little finished auctions hold temporarily, and the market would be more likely to trade into that unfinished auction. But I think in the context of the day, in the context of a very strong, grindy trend day, and thinking about the meta game of where other people are positioned, what's happening and so on, that becomes much more powerful, and it gives you a sort of a reference point when you're in the void and there's nothing, you don't know where up is down, and it sort of categorizes that information in your brain, and I think that's a strong edge. One thing to note, this very specific pattern, or this specific sequence, is much more reliable in thicker markets. I'd say thickness as in US 10-year, maybe bubble, but I think I've seen a number of times, and I have adapted it recently as well to bunds. So, but I wouldn't, I haven't looked at it, and I wouldn't recommend perhaps using it so much on gold and oil, because the way these grindy trend days play out are very specific to thicker markets like the US 10-year. Okay, so I hope that was very useful. I think it's something where you can easily derive a trade from. One thing to note as well, if we talk about how you would manage this trade and also put on risk, is you can be fairly creative with it. I mean, once you see we trade into this, for example, this price, we put in a very aggressive level, we snap back up. Because it's a thicker market, it should be slower. You should be able to at least hit some of these prices here, and then you have a very nice and tight stop. Again, your choice of how tight you want to keep it. how you want to manage that trade, or perhaps you just want to hit a blind, or use some other mechanism to confirm that that kind of trade for yourself. But essentially, that's the structure of the trade, and how you like to manage that risk and have the access to this. Then I think you can be quite creative and make it your own essentially. Okay, so and I'll quickly finish off by explaining how I've learned to use the footprint, how I've adapted it and so on. And it took me a while to really understand. When I first looked at footprint, I was like, okay, well, this is great, but I can just look at the ladder and see the same thing, which is not the case. And I put it to the side for a while, and then I really sat down and be like, okay, let's find a use for this. There must be some kind of edge which we can get, which we can extract from it. One of the things I think that a lot of people, or some people might struggle with, or at least it might help for you to understand, is that I think if you first look purely at order flow and you look at how people interact with, how buyers and sellers interact on the ladder, it's much easier to look at that first and then transfer that logic, that mechanism to footprint logic. So if you understand how prices are taken out by understanding that there are passive buyers or more aggressive buyers or more people who step up and take the initiative and take out the next price, is perhaps suggestive of one level of aggressiveness, and then maybe people who take out the next price and then immediately stack the bid is another level of aggressiveness, and how that mechanism works. Once you understand that, I think you can easily transfer the same logic to your footprint and already glean quite a lot of things from it. And and as a side note, it's much easier to have at least a little footprint on the side, because you don't have to remember every tiny rotation, counter rotation, or volume traded on the ladder when you have the footprint with you. One other thing that was very useful for me, and I think helps a lot, and something I lean on, is that if you take auction theory and you understand how auction theory works in the context of market profile, it very quickly allows you to understand footprint and how the auction works fractally. And what I mean by fractally is, people use footprints on different time frames and so on, but essentially the auction is fractal. So you could work on a smaller rotation, like how I showed you, or on a 5-minute footprint and so on. And what I mean by auction theory is understanding, for example, I put on here a market profile and volume profile, is understanding the nature and how, for example, these lows are formed and this tail is formed versus this one. Why is there a ledge here? How did this ledge form in the first place? Why did we quickly trade through these prices and then form, a ledge like these, which at the time was a ledge-like structure and eventually turned into a bulge? Why are there poor highs here, and so on? Because the reason you could quickly transplant is that many of the footprints, packages support a lot of custom, you can customize them quite well. And I think one thing that helped me a lot is having the software draw the footprint as its own volume profile, and from there you could glean certain things. For example, and I mentioned before, I'll explain why an unfinished auction sort of forms. If you take the logic of a poor high and a strong high, or a good high in the form of market profile, in a sense, this is basically a very strong, it's like a strong tail or a strong buying tail, because it formed quickly, the market didn't spend a lot of time there and traded higher. And essentially you could look at an unfinished auction as essentially a poor high. And from market profile that there is a strong tendency for the market to take out poor highs and trade through them. Well, an unfinished auction is formed in the same manner, just on a slightly more smaller time frame in the fractal sense. So I think that helped me a lot in understanding if I just take my market profile understanding and applying it to footprint, it immediately opens up a lot of your own analysis, your own way to think about it, and that was very useful for me personally. And again, I'm a big fan of leaning on finished and unfinished auctions. I go on about them all the time. That doesn't mean, as I said here, that doesn't mean I see one randomly formed on the footprint and then I just randomly click on the ladder because I saw it. it's always very well used in the context of a lot of things, on the context of the day, a lot of context technically. Perhaps, I use it just only as confirmation on some kind of trades, or I use a confirmation of when I can tighten my stop, add some more size and so on. And again, some people are quite flippant when they look at footprint things and they say, okay, well, that's great, looks that, but I can't make money with it. Well, again, I think the edge is a lot stronger or much more relevant when you put footprint in the grand context of everything else that's going on. And that's the sort of the main takeaway, the big takeaway I had when I started using footprint much more, essentially. Okay, guys, well, that's it from me. I hope you enjoyed it. I should be on next week as well. We should have something good footprint wise as well. I really hope someone might find that useful in terms of the actual trade itself, and perhaps you can come up with different ways to access that trade, to manage risk differently, and so on. All right, thank you very much.